Welcome to Wealth Coffee Chats, folks, for your daily live updates. Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes, and get ready to start your day, folks. Quick few housekeeping rules, though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays. Hey, good morning, folks.
Good morning, everybody. Welcome to another Wealth Coffee Chat.
Hope you're well, folks, wherever you are.
There it is, team. Morning. Morning, wherever you're tuning in from today.
Early bird gets the worm, they say. Here at Positive, we offer a 6-star team. It's a team that help you at every stage of your wealth creation journey.
General advice disclaimer. The information provided and made available through this podcast does not constitute financial advice. The information is of a general nature only and does not take into account your individual objectives, a financial situation, or needs. It should not be used, relied upon, or treated as a substitute for specific professional advice. We recommend that you obtain your own independent professional advice before making any decision in relation to your particular requirements or circumstances. Positive Tax Solutions and its representatives do not warrant the accuracy, completeness, or currency of the information provided on and made available through this podcast.
All right. Good morning, everyone. Welcome to Wealth Coffee Chats. I guess this is my first time on the episode. My name is Alex. I'm part of the financial planning team. Something new, something different. You would have heard a lot from other guys, all part of the 6-star team. And I guess now just to give you a couple of different perspectives, something new, and see where this goes, really. I guess put all your comments and anything in the chat. See where the interest is. I think that there's a couple of people jumping on, which is pretty cool. So, well, guys, I guess where can we start today? Obviously, first of all, coming from Melbourne, you have to have a good coffee. So I hope everyone's got one, and we can kick off into the day. There's a lot to cover off in financial planning sort of space, but I guess I'll just give you a bit of a rundown as to what we actually do, and then give you a couple of insights into a few things that you should be aware of going into the new financial year. I know we're a couple of months early, but you want to be ready as opposed to being surprised when it all comes around. So from my end, we're working with individuals and business owners. We're working to design a personalized plan for them for short, medium, and long term to make sure that their position is covered from immediate things like capital gains. You would have heard from the accounting team and Positive Tax about a couple of things on capital gains. Medium term things like if you want to purchase a property or investments? How do you do that? Where do you even start? And I guess long term, right? So obviously, over time, you want to build up all of your assets and then liquidate them into something that you can enjoy down the track. So today, what I want to cover off as one of my topics, and let me just have a look. I think there's a couple of more people jumping on, which is pretty cool. So today, I just want to cover off on just super basic stuff, and I think that this will. Hey, Steph. So, hey, Luke. How you going? Hey, Tim. Good morning. Good morning, all. Hope everyone's doing well. Look, let's start. Let's go right to the basics, right? So let's talk about super, right? So super will apply to 99.6% of the audience, and some people love it, and some people absolutely hate it. But I think that you should be thinking about how can I take advantage of it, and what are the key things that I can use this for, whether it's now or further into retirement. So I guess there's a couple of things that we should all be aware of that are coming from 1st of July 2025. And these two things are super guarantee changes. So that's going up. And the second one is the total super balance, which sounds complicated, but it's something that you should be mindful of, and it will be a super effective structure for you down the track that you could utilize and potentially have a lot of your income and assets held tax-free. So I've prepared a bit of a presentation just to give you guys something to focus on. So if you're a visual person, that's great. If you are on the podcast and listening into this, so I'll try to explain this as well as I can. But ultimately, if you need to, just jump back on the video and have a look at the slides. So again, general disclaimer, speak to your professionals before you act on anything. This is more general advice, just to give you a bit of a heads up. Don't take this as advice personally. Don't go away and start doing things just because you heard it here. Always speak to a professional. So let's have a look. Here we go. So what are the changes? Super guarantee. Well, what is super guarantee? You're probably all aware of it, or maybe not, but it is happening in the background. So your employee has to pay you a certain percentage per year, which is for the last 12 months has been 11.5% into your super fund. So you've got your income, and then there's super either on top of that or it's inclusive. So which we'll get to in a moment, because that is a very interesting sort of statement there that I'll chat to you guys in a moment. So ultimately, what's the purpose of this? It's really to make sure that you've got some level of funding when you retire, and you're less of a burden on the government through the Centrelink channels, right? So ultimately, we're going from 11.5% to 12%, and perhaps just a bit of a side note, this percent has been going up over the last several years. We had a bit of stagnation at 9% and 9.5% for a little while in the early 2000s, but really over the last couple of years, that has been going up each year. So now we've reached 12%. So I think that's been the target for a little while, and I think that's where we'll probably stay until that gets increased again in the future. There's no guarantee that it will, but at the moment, we are going to 12%. So you might say, well, what is it to me? I'm 30, or, I'm super young. I don't care about it. I'm not going to get access to it for 20, 30 years. Or you might be thinking, oh, hold on, I'm getting closer to retirement. What does that mean for me? So, there's I guess, what's the impact on you? The good thing is that, it's looking like your super will be increasing as a result of it, right? I used a bit of an example there. Someone who's on 100,000, perhaps 35, they've got maybe 25 years of work life before they want to sort of hang up their boots at age 60. Well, not taking any returns or anything into calculation, baseline, again, do want to keep this super simple, you should be about $25,500 better off as a result. So if we stayed at 11.5% and didn't go to 12, then you would have been a little bit short as a result. And ultimately, well, what does that mean for you? Obviously, you can only access super when you meet certain requirements. But it really means that, in retirement, your retirement benefits should really last you a little bit longer. So, and that's the entire point behind this increase, is that you will be self-funding your journey for a little bit longer before trying to tap into sort of any government benefits. But obviously, with everything that is good, there's always a bad or not so good sort of impact. And I guess in this case, one of the major ones, I guess there's few of them, but that means that you're salary sacrificing. So if you're doing that, what is salary sacrificing? Is just getting a little bit more contributions into the super fund each year. And because of the 12% increase, going from 11.5 to 12% increase, that means that your salary sacrifice amounts will need to be recalculated. We do this every year for our clients, just to make sure that they stay within the contribution caps, which are at the moment $30,000 each. And as a result, you don't want to get caught out. You want to speak to a professional and make sure that you check that for the new financial year. I do have a point here about potentially lower income. What does that mean? So you may or may not be aware, some contracts or some employment agreements have super on top of your base salary, and some have it inclusive, right? So if your super is inclusive in your base salary, well, that means that 12%, that 0.5%, will actually be reducing your take-home pay, but not a lot. But you'll still see that it'll be a few dollars less, perhaps. So I guess that's a conversation that you can have, with your employer, and sort of work out, well, am I plus super or am I inclusive of super, right? So I don't think that this will impact a lot, but something you should be aware of. And for our business owners, obviously, the impact for them will be higher payroll costs, essentially as a result of increased super payments that they have to make to their employees. Again, just like as a quick refresher, if you're working, you'll be getting super regardless of how much you earn now. So even if you earn like $300 a week, you'll still be eligible to receive some super on the back of that. So again, I guess the overarching message here is that speak to a professional. Super important to review your contributions if you're doing them. Again, contributions could be great for tax saving, building up your super, dealing with some of the capital gain issues. So if you go back a couple of episodes, you'll probably hear Anthony speak about the capital gains in there. So if you put 2 and 2 together, you'll probably see that there's a bit of similarity in here. But ultimately, overall, it's a good result with a couple of caveats in the background. Oh, here we go. Not so good. Okay, and the next major sort of change is the change to the total super balance. What is total super balance, you might ask? Well, it's essentially how much, bringing it back to super basics, how much can you put into your pension account from your super in the future. All right. So at the moment, or for the last couple of years, it's been 1.9 million. So which means, let's just say you accumulated your super whilst you were working. You got to, $1.9 million in super, and then you retire. So you can put all of that into pension. If you had a little bit more than that, then, the excess will have to stay in accumulation phase because you can't exceed the $1.9 million in pension. And pension is that tax-free income and capital gain structure. So that's changing. So that's going to 2 million. So that's a win, I guess. So if you worked a little bit harder and you saved a little bit more and your investments did a little bit better, then ultimately, now going into 2026 financial year from 1 July 2025, you can put away $2 million into the pension account. Again, the main benefit there is the tax-free thresholds that you can obtain. Again, what's the benefit of that, right? So you now $100,000 extra in the tax environment where you don't necessarily pay tax on, which means that potentially your long-term retirement. So this is more for the someone who's closer to retirement age. So it means that you can potentially sustain your lifestyle for a little bit longer in a more efficient way. Again, if you've already started doing this, so if you've already triggered some of the rollover from super to pension, then there's a bit of a calculation there that you'll need to get your professional to work out for you, because you might not be able to get to the full 2 million. It might be something like in pro rata basis between 1.9 and 2 million. So what does that mean for you? Well, for you, it means that if you're still accumulating, that means your goalposts have now shifted 100,000, which means that your new aim now is to sort of go towards the 2 mil as opposed to 1.9. So, it gives you a bit of an extra incentive to work a little bit harder, hopefully, and try to get as much of the assets into that environment as possible. So just to recap, make sure that, you speak to a professional about the contributions into the super fund as part of the increase to the super guarantee. And also perhaps, discuss, well, what does it look like in terms of my end retirement going from 1.9 to 2 million? Should I be, changing some of my strategies? Should I be looking at doing something different to get me closer and top up that additional 100,000? So like I mentioned, guys, super basic stuff. I think a lot of you would be doing this in the background regardless of whether you want to or not, because like I said, most of the Australian population is receiving the super guarantee as part of their employment. So just something to be aware of. If you are making contributions, additional contributions on top of that, you need to make that calculation again, recalculate your amounts that you're putting in, because ultimately you want to stay within the $30,000 cap. If you exceed that, then there could be some penalties in there. Just depends on how it sort of goes in. And then again, your long-term sort of strategy would be around, what does my retirement look like, and how much of that can I sort of utilize in a tax-free environment? So yeah, super simple. Hope you guys enjoyed that. So bringing it back to basics, right? So hopefully in the next couple of weeks, we'll bring you something, some of the detailed strategies that we perhaps work with our clients. So give you some live examples, and happy to hear what you guys think of this content, and reach out if you've got any questions, and have a nice day. Thank you.
Thanks for watching another episode of Wealth Coffee Chat, folks. Make sure you like, subscribe, and turn on your notifications so you never miss a thing when we go live. Improve your portfolio and investing game, folks, with Wealth Coffee Chats live every morning at 8:10 each weekday. Make sure you join us. Previous episodes are also available wherever you get your podcasts, folks, as well as our other podcasts from the 6-Star team here at positivementor.com.au.